Okay, we have this practice problem for Cadet Company that we are going to work through here. The first thing that we need to do is follow the steps in working out the statement of cash flows. And the first thing I would recommend to anyone is to go ahead and take the comparative balance sheets and do the calculations for do we have an increase or a decrease from the old year to the new year, and by how much. Alright, so we can see here with cash, at the end of 2014, we had $33,400. It increased to $78,700, which is an increase of $45,300. We will be pulling this number off of the balance sheet and using it in the bottom of our statement of cash flows, and we will be verifying our statement of cash flows against this ending balance for the year that we are looking at. So this is our check figure that we're going to come back to once we have completed our statement of cash flows. In looking at our current assets, we can see that accounts receivable went from $37,000 balance at the end of 2014 to $72,970. So we had an increase of $35,970. Inventory also increased. It went up by $19,250. If we go on and look at some of our other types of assets, we see here that our long-term investments went down from $107,000 to $89,500, so a decrease of $17,500. We can also see that our plant assets went up from $205,000 to $320,000, an increase of $115,000. But hopefully you recall that during the lecture portion of the class, I discussed the fact that we have got to ask for additional information because we cannot see, based on this information, if all we did was sell some long-term investments and all we did was buy some plant assets. We could have bought and sold long-term investments, and we could have bought and sold plant assets and still had a net decrease or increase. Okay, so we can't really see enough detail here, so we've got to ask some additional questions. The accumulated depreciation, that contra asset account, is listed here, and I do want to talk to my accounting and finance students about this a little bit more at the very end of this video. So if you plan on taking some type of certification exam in areas of accounting or areas of finance, you definitely want to pay attention to the things I say at the very end of the video. Going on to our liabilities, if we look at our current liabilities, accounts payable increased. In other words, we are in debt to another party. It went up by $9,420. Our accrued expenses payable, things like salaries and wages payable, things like that, have decreased from $18,830 down to $15,100, a total decrease of $37,30. Moving on, we can see that our bonds payable has gone from $70 up to $140. That's a $70,000 increase. And our common stock went from $200 up to $250, which is a $50,000 increase. In regards to this bonds payable here, same kind of thing applies. We need to ask some additional questions because we could have sold some bonds only and gotten a $70,000 increase, but could we not also sell some bonds and also redeem or pay off some bonds and have a net of $70,000 increase? Okay, so that's a reason why we've got to ask some additional questions. In regards to retained earnings, recall that there were some formulas that we discussed in Principles 1, where first of all we do the income statement and we get the net income. On the statement of retained earnings, the second financial statement, we learned that we would take our retained earnings, in other words, earnings that have been generated over time since the beginning of the company, that have not been paid out in the form of dividends, are retained within the company. All right, so this is our beginning retained earnings number for the period. All right, so on January 1 of 2015, we would start with 107,940. We would have generated a net income for the period. That net income would get added to this number on the statement of retained earnings. We would then subtract any dividends that were paid, and then have a new ending retained earnings number, which then went to the balance sheet, and that is this number for the end of 2015. I'll show you that I'm going to take these numbers and plug them in and show you that if you are not given the amount of dividends that were paid, you can calculate it. All right, so everybody understands that Wiley Plus is going to be somewhat challenging and occasionally makes you back your way into the information that you need in order to solve a homework problem. Moving down here to our income statement, there are several things that we need to pay attention to because we are going to pick pieces off of the income statement in order to generate our statement of cash flows. All right, so keep in mind that our income statement, our statement of retained earnings, and our balance sheet are all being put together using the accrual method of accounting, which we learned about in Principles 1. We recognize revenues when we have earned that right to recognize them. We've either performed a service or provided a product. And we recognize expenses when they are incurred, whether or not we've paid for them yet. All right, so the statement of cash flows is going to take those three financial statements and some of the information contained within them and flip them around, and we're going to be able to see additional or a better viewpoint of activities that have occurred at the business during the period from a cash basis. So we're looking at the cash inflows and the cash outflows. All right, so we generated some revenues. We may or may not have been paid for those yet. Again, think of the fact that we have put them on accounts receivable. And then we have also sold off a piece of our property, plant, or equipment. Now here we have recognized that by showing a gain on sale of plant assets for $3,000. We're going to pull this number off and we are going to use that. All right, so this is the gain. The gain is not how much money we received for that asset, the proceeds, the check we received from the buying party. This is the gain recognized when we look at the proceeds versus the book value, which I will get to that down here in just a few minutes. In regards to our expenses, we've deducted from our revenues for the period certain types of expenses. We are focusing on the indirect method of putting a statement of cash flows together. If we were doing the direct method, we would be doing this a different way for the operating activities section, and we would use some of these other items. However, all we really want to pull off here for the indirect method is the non-cash items. All right, so depreciation expense of $35,500. is showing up here. If we had amortization expense, we would pull that off, and we would also pull off depletion expense if we happen to have those. All right, so these are things that you should be circling on your paper or writing them out. In regards to the additional information that was given, we did purchase new plant assets costing $151,000 for cash during the year. All right, so we, the company, are investing in additional plant assets. That's a cash outflow. Again, notice the key words here. It says for cash during the period. If we had made some type of exchange, one dump truck for another dump truck, one building for another building, we would not be showing that in our investing section as an inflow and an outflow. Those would show up as a significant non-cash, because if cash does not change hands in the transaction, then it is not going to be in the body of the operating, investing, or financing areas. All right? Investments were sold at cost. Let's go ahead and take a look at that one while I have it pulled up. If investments were sold at cost, they were sold for whatever we originally purchased them for. All right, so if you go back up here to the long-term investments, it went from 107 down to 89,500, a decrease of 17,500. Therefore, that means that this 17,500 historical amount of what those were bought for is exactly what we turned around and sold them for. Okay, so 17,500 is going to be a cash inflow in the investing section because we have sold off something that we had invested in at a prior time. Plant assets costing $36,000 with accumulated depreciation of $26,000 were sold for $13,000. Now, this number 3 right here is where this gain of $3,000 came from. So the formulas you would need to utilize, you learned back in Principles 1 in Chapter 9. And here they are. All right. Historical cost, $36,000 minus the accumulated depreciation for that specific asset. Both of those items would have to be moved off of our balance sheet when we no longer own that asset. The book value then, the difference between those two numbers, or what would have been remaining on the books, the net book value, was $10,000. Therefore, we're going to take that book value and compare it to the cash proceeds, or what was literally received, and take the cash proceeds and compare it to the book value. If the cash proceeds are greater than the book value, then we have what's called a gain. It's kind of like making a profit off of selling some of our property, plant, and equipment. If, however, our proceeds are less than our book value, then our result would be a loss. The cash proceeds number literally is cash received. Therefore, that cash received is going to show up as an inflow in the investing section. However, if there is a gain or loss, the gain needs to be subtracted, and if we have a loss, we're going to add it back. What's an easy way to try to remember that rule? Think about the fact that a loss is kind of like saying depreciation expense that was not able to be taken. is the amount of the loss. Therefore, what do we do with depreciation expense? It's a non-cash item. Under our indirect method, we always add back depreciation expense. Therefore, we are always going to add back losses. If we're going to add back losses, what are we going to do to gains? We're going to subtract them. Okay, let's go ahead and start piecing this together. Let me unhide the rest of my stuff that I have already typed up for us. Again, what I was mentioning earlier about the retained earnings statement, which was statement number 2. Basically, it was 107,940 was our retained earnings number at the end of 2014. We would have generated net income during 2015, which is coming from right here, the 107,830. And we would add those two together to get a number. And then from there, we would subtract any dividends declared and paid. All right, so 215,770 minus something would equal our ending retained earnings. All right, so if we were given this ending retained earnings and this beginning number, could we not calculate how much the dividends were? Yes, we could. All right, so beginning retained earnings, add net income equals a number. That number minus dividends paid equals the ending. Therefore, you could take this number and minus the ending in order to fill in the dividends paid. So, I believe you guys could calculate it. Again, Wiley's going to challenge you. You may have to use that now. You may also have to use it on some other type of test at a later date. All right, let's take a look at putting together the statement of cash flows. You always want to label it with a company name, the name of the financial statement. This is the 4th financial statement. And it is for the same period as that of the income statement and the statement of retained earnings. It will have the last date that corresponds with that of the balance sheet. Okay, so it's for a period of time. If the income statement is for the year, then the statement of cash flows that goes with it is also for the year. If this was for a quarter or for a month only, that is what this would also be for. Again, notice December 31st, 2015 is matching up with our balance sheet as of this period. We would begin by pulling off net income from the income statement. We are doing the indirect method. So pull off the 107,830. Notice that each section is labeled cash flows from operating activities, investing activities, and financing activities. Starting with net income, we then need to adjust that number based on analyzing the changes to non-cash or other current assets other than cash and current liabilities, and then adding back non-cash expenses like depreciation, adding back losses, and subtracting gains. Alright, so we pulled off the depreciation expense and immediately add it back. So add back depreciation expense. Notice it's a positive number here. The gain on the sale of plant assets. Notice that I did give you guys the calculation. Alright, we could calculate the gain, but they did spell it out for us here. Okay? But you guys know how Wiley is. They may have you actually calculate whether or not you have a gain or loss yourself. Alright, so gains are subtracted. Our accounts receivable number increased. whenever we have an increase in a current asset, we subtract it. Alright, so notice that our accounts receivable increased by $35,970 and our inventory increased by $19,250. Therefore, both of those increases, the dollar amounts by which they increased, needs to be subtracted. On our current liabilities, our accounts payable went up by $94.20, but our accrued expenses payable went down by $37.30. When we have an increase in our accounts payable, we are using our good credit. $9,420 needs to get added back. Under the accrual method of accounting, we can have expenses that we incur that get expensed out on the income statement, but we have in essence charged them up and we sooner or later pay them down. Therefore, that decrease in accrued expenses payable, it is going down. We are using our cash to make that happen. So notice that it's being subtracted. Net these together, just what has occurred during the period. Plussing and minusing ends up with $17,030 negative or uses of cash. We're going to take that and net it against net income. So 107,830 minus 17,030 equals 90,800. We have provided cash in our operations based on our net income and our other items that needed to adjust. We will come back and we will use this 90,800 here in a few minutes. Cash flows from investing is the second or the middle section. We sold a plant asset, and this is literally the cash proceeds received. It's going to show us a positive amount or an inflow. We calculated that we have sold some investments for $17,500, their original cost. Inflow of cash in the investing section, $17,500. And then we were told that we purchased plant assets of $151,000. The $151,000 is an outflow, so notice it's a negative amount. Net cash by investing activities, positive 13 plus positive 17,500 minus 151,000 outflow gives us a net result of a negative 120,500. Therefore, notice this word right here says used. Used when it's negative, provided when it's positive. Moving on down here to our cash flows from our financing section. We sold common stock for $50,000. We issued bonds for $70,000. And then we paid out cash dividends of $45,000. Alright, so these numbers were based on the additional information that we did gather down here, and then in looking at our bonds payable and our common stock and our additional information, we were able to come up with these numbers. Alright, so inflow of 50 and an inflow of 70 equals an inflow of 120. However, dividends paid out of 45 equals a net of 75,000. Now, this 75,000 is a positive amount, so notice I've selected the words provided here. Now what we need to do is calculate and finish the bottom. 90,800 positive provided by operating minus the 120,500 used in investing plus the positive $75,000 provided in financing results in a net positive increase in cash. All right? It's an increase. That's a good thing. Could you see a net of a negative number? Yes, you could. All right? If you did, you would have to subtract that from this next number, cash at beginning of period, and you would therefore have a lower number at the cash at the end of the period that would correspond with your balance sheet. But we do have a net positive or increase in cash of $45,300. This number gets added to last year's cash balance as of the end of the last year. All right, so if we were to go back up and look at our balance sheet, we saw that cash at the end of 2014 was $33,400. That number is what we're picking up and putting it down here at the bottom of our balance sheet. That is the amount that we would have shown on 1/1 of 2015, because this is December 31st, 2014. We would have gone home, gone to bed, come back in the next morning, and January 1, 2015, we would still have this much cash. This $78,700 is our reconciling or verification number. All right, so if we go back down to the bottom of our financial statement here, $45,300 increase plus cash at the beginning of the period of $33,400 results with cash at end of period $78,700. Therefore, our number matches our balance sheet as of December 31st, 2015. We should be good to go. I did want to mention to my accounting and finance people that there are ways that you can go and find numbers that you are needing. I want you to think back about the way an asset is sold off. Again, we talked about this historical cost and this accumulated depreciation. Here's what the accumulated depreciation numbers show up at the top. There was a beginning balance of $40,000 at the end of 2014, so this would have been our beginning number for 2015. During the year, we had recognized depreciation expense of $35,500 per the income statement. And if you guys think back, we always debited depreciation expense and credited accumulated depreciation when those were recognized. All right, so notice I'm taking the beginning balance of 40 and I'm adding the depreciation expense as shown on the income statement and getting a total number of $75,500. All right, so a credit balance plus the credits equals this. But recall that I said that when we sell off an asset, we also have to remove its accumulated depreciation during the year. What if you were not given the accumulated depreciation in your set of facts? Could you figure it out? Yes, you could, by pulling this off of the comparative balance sheet, pulling off the depreciation expense off the income statement, adding those two numbers together, and then subtracting the ending balance in accumulated depreciation. And what would result would be the amount of accumulated depreciation for the asset that was sold off. And I'm showing you this so that those of you who plan on taking a certification exam, I can assure you that you are going to be challenged with questions that are going to really make you think, how can I find the pieces of the puzzles? Right? So you're given enough information, You may have to draw out your T accounts. I could have done this in T account format, and backtrack your way through. Okay? You could also do the same kind of thing with your information regarding the plant assets. Notice that we have $115,000 change. Get a different color here. But we were told that we bought $151,000. So we started with $205,000. If you guys can watch where I'm at over here. We started with $205,000. We bought something for $151,000. If we sum those numbers up, we get $356, and we're needing to calculate something. What was sold off in order to end at $320,000? All right, so what I'm saying here is, what was the historical cost of the asset that was sold? All right, so how could we do that? Take this 356 minus the ending balance of 320, and we would be able to see that that is in fact the $36,000 historical cost. Okay, so here's our beginning. Here's the purchases. There's the result. What was sold? What was its historical cost? And here's the ending balance. So we just solved to find this. Again, it matches up our information that was given to us right here. But again, be prepared for those certification exams. Work your way back through your information.